Hi, good afternoon to everyone. We are happy to begin our usual routine on monthly market outlook. If we look at US economy, it's facing one of the highest inflation in recent times. Next slide, please. The Fed is clearly behind the curve. Inflation is now almost touching double digit, and interest rates are just about 2.5%. Next slide, please. There is an impact on US economy as orders have started slowing down dramatically. Their consumer sentiment is now at a level last seen in the 60s. And the US bond market right now is predicting recession. In fact, as per the English definition, US is already in recession because for March 22 quarter, their GDP was negative 1.4%. And for June 22 quarter, it was negative 0.9%. But US is US. What applies to other does not apply to them. They have their own ground rule for declaring themselves in recession. On the other hand, the employment market continues to remain strong in US. For every one employee who is unemployed, there are 2 job openings there in the economy. Because of this confusing signal on strong employment, recessionary GDP, and other factors, market is now pricing in that Fed, instead of raising Fed rate to 3.8%, will probably stop at 3.3%. In fact, they are now pricing in a rate cut in 2023-24, where Fed rate will be down to 2.7%. In that background, if we look at global economy, well, inflation is a challenge for major parts of the globe. 80% of the global countries have CPI above 6%. Housing index all over the world has started correcting. Generally, soft housing or correction in housing is indication of recession. Overall growth has started faltering thanks to higher oil prices, thanks to higher inflation, and thanks to raising interest rates by central bankers. From about 4.3% growth in the beginning of the year, now we are looking at 3% GDP growth for CY22. The same downward revision has happened in 2023 for the global economy. The one silver lining among dark cloud is drop in commodity prices. Commodity like aluminium is now at par with the prices in May 2021. However, the commodity where India wants maximum correction, oil, that is down only about 14%. One thing which is visible, whenever inflation has peaked out, stock markets have rebounded. If we go back to the 70s, rising inflation resulted into stock market correcting by about 50%. But moment inflation started coming down, stock market bottomed and started going up. Will the 70s picture get repeated in 2020s? In our opinion, yes. The first half of the movie was like a horror movie. Inflation up, interest rates being raised, liquidity getting tightened, demand getting curtailed, growth slowing down, and overall markets going down. Now, if this horror movie has to have happy ending, then they need to add masala in the second half. In the second half, inflation will be lower, interest rates will be cut, liquidity will be increased to support demand and growth, and eventually markets will move up. We believe major part of first half is over. We are somewhere reaching a stage of intermission, and then second half should begin. Is there a possibility that the second half also is a horror movie and not happy ending? Answer is unlikely. As Fed raises interest rates, US economy will go into recession, and recession generally brings down inflation. And then this cycle can begin. The whole hope right now is that Fed will not unnecessarily tighten more than needed. And if that turns out to be true, then the movie will have happy ending. Market has already started pricing in happy ending. In the month of July, developed markets as well as emerging markets bounced back quite sharply. Japan was up 5%, Nasdaq was up 12%, and S&P 500 was up about 9%. Indian economy is truly an oasis in the desert. In just about 2 years, we have seen a very, very different scenario. April 20 to October 21 was bull run in market because central banks were cutting interest rates. Corporate profit growth was very, very strong, and FPIs were big buyers of stock along with retail investors. October 21 to June 22 was a bear market. Central banks started raising interest rates globally. Russia-Ukraine war put an end to corporate earnings cycle. Retail participation thinned out in direct equity. Fortunately, thanks to all of you, it didn't happen in mutual fund. And FPIs were on record selling spree. July 22 is turnaround. Now, central banks may not raise interest rates as much as feared. Inflation seems to have peaked out, and FPI have suddenly discovered India and started buying. If you see the headlines, majority of headlines were positive, whether it is PMI, whether it is corporate credit growth, or whether it is exports. GST collection remained fairly high. The only worry for India, please go back to previous slide. Thank you. The only worry for India is a trade deficit which came at $31 billion a month. Normally, this kind of trade deficit used to come on a quarterly basis, but this time it came on a yearly basis. This is one red flag for India. The second red flag for India is slight deficiency of monsoon, especially in northwest and northeast India. The expectation of rainfall in northwest and northeast India has not been met as much as in the rest of India. Subject to trade deficit and monsoon, all other parameters on Indian economy are showing very, very strong rebound. GST collection for the 5th month in row remained above 1,40,000 crore. Based on those tax collection, central government receipts are now bulging. They are growing ahead of budgeted estimates. With that money, government is spending money on rural and infrastructure building. As government has got more money, they are likely to spend more money on rural economy, and that should support rural economy. The government, despite spending of money, is also having very high cash balance with RBI, almost 5 trillion rupee. That money will come handy in supporting growth in the days to come. The government has been spending money for infrastructure investment. Now, listed corporate India has also drawn their capital spending plan from about 10 trillion rupee in FY16. FY23 is likely to see doubling of capex to rupees 21 trillion. A large part of this will be driven by government, but there is a sharp increase in corporate sector's investment also. Capacity utilization from bottom 47.3% is now around 75%. At this level of capacity utilization, businesses will start investing. If you remember, in our earlier presentation, we had mentioned how people, especially at the middle and lower end of strata, are being hit by inflation, and which is where we had seen FMCG growth in terms of volume as well as value slowing down. In fact, Jan to March 22 quarter FMCG volume was negative, as people who could buy 5 biscuits pack were buying 4 biscuit packs. Fortunately, now consumption seems to have bottomed out. April to June, there is still negative, but it is substantially lower than what we saw in Jan to March 22. And as companies passed on price increases to consumer, the value growth is about 11%, almost double of what we saw in Jan to March 22 quarter. As businesses have started investing, they have started borrowing. Credit growth is now firmly in double digit. While rainfall is not so good in Northeast and Northwest India, in rest of the country, rainfall has been above average. A good rainfall will mean better agriculture, better rural economy. With all the challenges of oil, Russia, Ukraine, and US Fed, India was the fastest growing economy in 2021. It is likely to be the fastest growing major economy in 2022, as well as even 2023. Sometime back, I had tweeted Bloomberg analysis about countries where economists are expecting recession, and India was one country where no one was expecting recession. This tweet got almost 660,000 impressions, as the catchy title, "Sometimes Zero is Good," caught on among the social media. For our economy, the biggest pain point is higher oil prices. We import about 4 million barrels of oil every day. Last year, oil was about $75. If it is $100 today, that means that's an increase of $25 per barrel. It's roughly about $100 million extra spent every day. That is rupees about 800 crore. Now you can imagine if this continues for 30 days, we'll end up spending 24,000 crore extra. And if it keeps on spending for a year, we are looking at a substantially higher money of 24,000 crore into 12, roughly about 3 lakh crore. This is the price we have to pay for higher oil prices. On oil, there are conflicting views. Citibank's research report says oil will collapse to 65 if everything goes right. And JP Morgan feels oil can go to 380 if everything goes wrong. Let's hope and pray that oil comes to $65 and our economy benefits out of it. Converting that into equity market, we withstand one of the worst FPI selling in our history. Between October 21 to June 22, they sold $32 billion of equity, double that of what they had sold in 2008 financial crisis. Why were FPI selling? Well, we continue to trade above our own historical averages. On an average, we trade at about 40% premium to MSCI emerging market peers. Now, currently, we are trading at 74% premium, double that of our usual premium. Second, FPIs have made tons of money in India. For years, they invested in Brazil, and in the whole of last decade, they have got negative return. They invested in South Africa for the whole of last decade, got 2% return. We have delivered double the return, triple the return of emerging market peers, including China. Now, when you make so much money, obviously there is temptation to take that money out. However, all the foreigners who have taken the money out have not been able to deploy it in a profitable trade. Last month, India was up 9%. China was down 10%. Long India, short China trade would have made money. Unfortunately, FPIs ended up putting short India, long China trade, which isn't working. This is an interesting slide. In the past, whenever FPIs used to sell, our markets used to correct. In 2008, our markets went down 60% when FPI sold about 50,000 crore of equity. In 2020, our markets corrected 40% when FPI sold 48,000 crore of equity. As we speak, they have sold 250,000 crore, and yet our markets are down just about 7%. Clearly, that is possible because of the superb support by domestic mutual funds. You people have given us money. With that, we have gone and bought out FPIs. Many people ask me, Nilesh bhai, are we giving exit to FPIs? My answer is, thank God that FPIs are selling. Otherwise, with this kind of money, either we would have been buying at 20,000 Nifty, or we would have been sitting in cash watching prices go up. So FPI selling has been fairly positive for domestic mutual funds. More importantly, this slide had become viral when we published this in the month of July. On 7th or 8th of July, in our last monthly presentation, we put this slide and suddenly it went viral. We mentioned here that in the hypothetical scenarios, if FPIs continue to sell, then domestic institutional investors led by mutual funds have enough dry powder to buy them, provided SIP flows continue. This resulted into so many phone calls coming to me saying that, Nilesh bhai, what is this you are talking about? And I said, thanks to my mutual fund distribution partners, we are today in a comfortable position that even if you sell over next 12 months what you have sold in last 9 months, we will be in a position to absorb. it won't be imprudent to say that this one slide stirred FPIs to think about their positions in India. And in just about 15 days after publication of this slide, FPIs turned buyer in Indian market. Obviously, that slide alone was not the driver for FPIs buying. Their stake had come down from 21.5% to 19% in just about 6 to 7 quarters. That was very close to what was their lowest holding in recent times. Clearly, their selling was coming to an end. Second, MSCI emerging market corrected versus developed market, and now they were looking as attractive as in 2002 or 1988. And you could see how around those valuation, emerging market delivered great performance. Can this year be similar? Answer is, who knows? We could see similar bounce back in emerging market. There is also an interesting opportunity. Most FPIs invest looking at MSCI Emerging Market Index. In MSCI's counterpart FTSE, Korea has been moved from emerging market to developed market. In MSCI, Korea has about 8% weight. If Korea gets upgraded to developed market and that 8% is distributed to India, our weight will increase in MSCI emerging market by 96 basis points. HDFC is part of MSCI. HDFC Bank is not. But once they merge, if HDFC becomes part of MSCI India, then to that extent, our weight in MSCI index can go up. If RBI in tomorrow's credit policy announces increase in FDI limit to 100% for banking sector, or if government announces that in the budget, wherever it happens, it can increase India's weightage in MSCI index by about 1 to 1.5%. Now, if we take this kind of steps, from current 12% weight, will go to roughly about 14.5% weight. This will pull FPIs to invest in India. At this valuation, we believe market is fairly valued. And most important thing, every correction is an opportunity to increase allocation to equity. If we see the market cap, the blue line goes in line with profit pool. Sometimes market cap is above profit pool. Sometimes market cap is below profit pool. But invariably, their direction is linked together. At this point of time, you can see that profit pool and market cap is in fairly close proximity. That means the market is fairly valued at this point of time. Corporate India's earnings have started bouncing back, and now profit to GDP ratio for NSE 500 company is 4.3% above our historical average of 3.7%. On the P ratio basis or price to book basis, we are near our historical average in terms of valuation. The June 22 quarterly results which came is by and large in line with market expectations, and the earning revision for 2022 is barely about 1% point in last 6 months, and for 2023 about -2%. We are looking at 860 rupees earning per share for CY22 and 967 for CY 2023. The real question is, will companies' profitability continue to remain strong? And here the worry essentially emerges because our wholesale price inflation is at about 15%. This is what companies are getting hit with. And the gap between wholesale and retail is negative at about 10%. That means companies' margins are getting depressed as they are paying on raw material WPI inflation and they are getting on sales price CPI inflation. Now, slowly and steadily, this should come back to par. That will be good for corporate profitability. At this point of time, our call continues to remain neutral weight to equity overall, within that marginal overweight to large cap and marginal underweight to mid and small cap. And whenever there is correction in the market, it's a great opportunity to increase your equity allocation. In last time's monthly call, we had talked about somewhere around 15 to 15,500 below where one can become overweight on a gradual basis. The markets have run up pretty sharply. So use correction as an opportunity to invest. Why should you invest during bad time? Well, you only make reward if you invest during the storm. This time markets were down 17% and it is already up 13% from bottom. And we believe there is more journey to come in the future. This is very interesting slide. We have divided market in 4 components: compounders, companies in IT, pharma, FMCG, private bank, and financial services. They continue to chug along and make money for investors. Global commodities like metals, materials, energy, trading, their fortune depends upon global factors. Local cyclicals, that is auto, real estate, PSU bank, cement, industrials, media, consumer discretionary, and utilities like power and telecom. Now, this chart shows market cap share, less profit share. Obviously, companies whose market cap is more than their profit share, they are expensive. And companies whose market cap share is less than profit share, they are cheaper. And you could see over a period of time how those things have changed in this century. At this point of time, we believe local cyclicals market share in profit is much higher than their market share in market cap, and hence they look attractive from an investment point of view. Whereas global commodity stocks, metals, materials, energy, trading, their profit share is less, but market cap share is more, and hence they are worth avoiding. To illustrate that point further, auto sector today gives about 2.5% share in profitability. At the bottom, it was about 0.9, and at the top, it was about 10.5. We believe auto sector journey is from 2.5 to 10.5 in profitability, and hence stock prices will be supported. The same thing on industrials. Current profit share is about 5.4% in top 1,000 listed companies. Peak was 9.3%. We believe this journey will continue in the days to come. The cement industry, current share is 1.3. Peak was 3.2. We believe this journey will continue, but more like this rather than upper way. This 1.6 will decline probably a little bit and then climb back towards 3.3%. In consumer discretionary, again, the journey is likely to continue from 1.3 to 4.4%. These are the 4 sectors, the domestic cyclicals, where we believe there is good opportunity to make money as their profit share expands and market cap or share prices follow through. On the equity investment side, we have as usual, our Kotak Blue Chip Fund. It got 30% of the net inflows in large cap category because over the years, it has consistently outperformed its benchmark index. There are very few large cap funds which continue to outperform their benchmark index, and Kotak Blue Chip Fund is one of them. The other fund which we would love to talk about is Kotak Focused Fund. Again, it's a portfolio of 30 stocks picked up on a bottom-up stock research. It is large cap bias stock, and it has delivered outperformance over its benchmark indices like Nifty 500, Nifty 200, or even Nifty 50, where we would love to position this fund. The other fund which is worth noticing, well, today people want to invest in funds which have some local exposure, some global exposure. There are about 7 funds in this category, and about 18,000 crore sales happened in last 1 year. Now, in this category of 7 fund, Kotak Pioneer is one of the best performing fund year to date, and comparable performance on a 3-year basis or since inception. Today in this fund, 19% is invested globally, 81% is invested locally, and it has delivered 4% alpha over its benchmark index since inception. Out of this other 7 funds, many funds are of 10,000 crore size, 20,000 crore fund size. But despite giving this performance, Kotak Pioneer Fund is just about 1,500 crore in size. We believe there is a great anomaly over here, and Kotak Pioneer Fund should be considered in every investor's portfolio who are seeking global as well as local exposure. Next time, my colleague Harish Krishnan, who manages Kotak Pioneer Fund, will talk more about it. But certainly as a distributor, it is your opportunity now to take Kotak Pioneer Fund to all those investors who have put this 18,000 crore worth of money in some of the underperforming fund or equally performing fund. Our funds continue to generate alpha, bearing few exceptions like FlexiCap Fund over last 5 years and Blue Chip Fund, which gave marginally negative alpha on a 5-year basis. Our hybrid fund continues to deliver outperformance over benchmark index. We have a category of fund which on the way up goes like rabbit and on the way down comes like tortoise. Look at Kotak Equity Savings Fund. It can put 10 to 50% in equity as per offer document. Average equity allocation is 29% over last 8 years. And with that allocation, it has given 39% upside participation and 14% downside participation. It has an upside downside ratio of 3, and current equity allocation is about 34%. Kotak Equity Savings Fund is an equity fund, and hence it has taxation in line with equity mutual fund. Kotak Multi-Asset Allocator Fund of Fund allocates between 5 to 95 in equity. Their average allocation is about 46%. But with that allocation, it gives 65% upside participation and 29% downside participation. The upside downside ratio is healthy too, and currently it is 72% in equity. Kotak Balance Advantage Fund हमारा हर फंड मौला fund है. It can go traditionally between 20 to 80% in equity. 42% is its average equity allocation. Upside 56%, downside 36%. Upside downside healthy too. Current equity allocation at 54%. Clearly, these are the funds which can be positioned to conservative investors, investors who are afraid of volatility, and they can all benefit from this fund's unique structuring of buying more when markets are cheaper and booking profit when markets are expensive. Kotak Global Innovation Fund we had launched in February 2017. The timing was horrendous. Immediately after our launch, there was China tech meltdown, US Fed rate increases, and correspondingly global tech meltdown. This NAV dropped to almost 6 rupees, but now it has bounced back quickly, and now it is down to about 7.3%. It is still 27% lower than the price at which we had launched the fund. But we are hopeful that as recent performance shows improvement, future also will see that kind of improvement continuing. Kotak Multi-Cap Fund was launched in September 21. It has 46% in large cap, 26% in mid cap, and 26% in small cap. And as of 29 July 2022, the NAV is very, very close to par value. This is one of the best performing multi-cap fund in its time period of less than a year. We believe this is must own among customers' portfolio. And like our other equity fund, it has delivered a positive alpha of about 0.8%. In our SIP also, people continue to get alpha. In fact, there are funds like small cap where alpha is even superior to the return which fund would have generated. We are also launching now Smart SIP, STP and SWP facility. We have SIP, STP, SWP facility in our fund. What is Smart SIP? Well, it allows you to buy more when valuations are cheap. It allows you to buy less when valuations are expensive. Essentially like balance advantage fund, buy when markets are cheap, sell when markets are expensive. This is something which we are following in our Smart SIP concept. If you do normal SIP in a fund like Kotak Emerging Equity, you would have invested about 1.88 crore and value of that would have become about 8.07 crore. This is assuming SIP of about 1 lakh rupee per month since inception of the fund. But if you had chosen Smart SIP option, which would have made you buy when markets were cheaper and sell or invest less when markets were expensive, the gap would have been far, far better. In a normal SIP, your investment would have become 1.51 crore. In a Smart SIP, it increases by about 30 lakhs to 1.88. But against 37 lakh rupee additional investment, your mark-to-market gain is about 2.69 crore. So Smart SIP is a better way to do SIP. Smart STP will be a better way to do STP. And Smart SWP will be a better way to do SWP. This will add more value to customers' portfolio. Coming to fixed income market, inflation is raging across the world. But because commodity prices have started correcting, people are expecting central banks to raise less than what is priced by the market. Globally, now yields have started correcting across the market. In case of India, we are in a far better position with a very, very stable real interest rate scenario. This is now 11th month in running since September 21, where American inflation has remained above Indian inflation. This has ensured that India's real interest rate differential vis-a-vis US continues to remain above historical averages. That should support rupee little bit from depreciating. RBI is also expecting inflation to come below 6% in FY23 fourth quarter. That will be purely function of oil prices. But at this point of time, inflation trajectory looks downward trending. The liquidity remains controlled between RBI and government, and they have managed this liquidity transition very well. From excess liquidity now, we are at reasonable liquidity. Market has priced in lot of action by RBI. Tomorrow, there will be rate hike by RBI between 35 to 50 basis points as per market expectation. And it seems that that is what is already priced by the market. At this point of time, the 3-year to 7-year segment on fixed income looks fine. At the short end, curve is steep. At the mid to long end, curve has become flatter. This is the most attractive part to invest your money. Within the debt, when you're looking at short term, you can choose between money market, savings, and low duration fund. When you're looking with medium term option, look at corporate bond fund, floating rate fund, bond short term fund, and banking and PSU debt fund. If you're investing with 3-year plus horizon, look at Kotak Dynamic Bond Fund or Kotak Bond Fund. In the past, a lot of investors were investing into roll-down strategies where the fund continues to maintain maturity which they had bought at the beginning of the fund. We believe dynamic funds are a better bet than roll-down funds. And we have done back testing of a roll-down fund vis-a-vis our actively managed fund like dynamic bond fund. In every single scenario, our dynamic bond fund has delivered better return than roll-down strategy. If you look at Kotak Dynamic Bond Fund, it has done extremely well in delivering better return than benchmark index over last 4 years. For conservative investors who are worried about lower return in bank fixed deposits, company fixed deposits, hybrid fund like Kotak Debt Hybrid Scheme or Kotak Equity Savings Fund or Kotak Equity Hybrid Fund will be best opportunity. All of them have added value to the customer's portfolio over last many years, but also delivered high single-digit to double-digit return to investors over a long period of time.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.